Bangalore now. Upinder Jucci, Managing Director of Infinite Computer Solutions, now joins in for a boardroom. Mr. Jucci, thanks a lot for joining us, sir. You've done about 6% revenue growth quarter on quarter and about 10% profit growth on back of higher margins. Is that a trajectory that you're going to sustain between Q2 to Q4? Because that's what you'll require to actually meet your guidance.
Yeah, thank you very much for inviting me on the show. Yes, as you see from the results, the Q1 results have been fairly encouraging, and it was a good quarter, and pretty much in line with what we had guided for this fiscal year, which is roughly about 35% growth, both on top line as well as bottom line in terms of US dollars. So we're fairly confident that over the next 2 to 3 quarters, we should be able to achieve that, and based on the visibility that we have today, as well as the order book from the existing client base, we're fairly confident that we should be able to, meet our guidance.
Hold that thought, Upinder. News coming in that government has moved a step closer to helping out HMT with a 100 crore loan, seeking parliamentary nod, and that stock excited because of that. That will be, of course, important for HMT. But Upinder, coming back to your performance in the quarter under review, you've managed to actually increase your margins, and some of it has come because of a decline in other expenditure. Can you elaborate? Is this sustainable? Considering that many other software companies have actually got beaten down because of attrition and higher wage costs.
We look at, if you see the margin expansion and the growth that we have seen over the last 4 or 5 quarters, and what we expect to achieve over the next 3-4 quarters, is a combination of multiple factors, including SG&A rationalization. Now, that's not really the only one. More important than that is the change of the business mix that we are pursuing in terms of the contribution of the businesses that are of higher margin, both gross as well as operating margin, continues to grow up as we move forward in terms of intellectual property, revenue share-based businesses that we have acquired and we're executing now, as well as some of the remote infrastructure management projects that we're executing. As a combination of that, we are fairly confident that we should be able to maintain, not just maintain actually, keep enhancing and expanding the margins as we move forward.
Would you want to give a guidance? 17.98% is what you have done in EBITDA margins. How much can it improve
right
to?
See, in terms of the annual guidance, as we on the last call we were given was 35% growth, which we're typically talking about 190 to 195 million US dollars in revenue. As far as the profit after tax is concerned, it's we're guiding about 22 to 23 million US dollars. And the Q1 numbers that we've just seen are fairly in line with that annual number.
So your top 10 clients form a large part of your revenue. About 92% is coming from that. That's a bit of a concern. Do you plan to bring it down?
Yes, we do, but as I keep saying on every call, as the core strategy of this organization is to engage with large corporations, very global Fortune 100, Fortune 500 corporations. Now, the fundamental thing what happens when we engage with such clients is typically they become a very large engagement for us. If one has to sustain that relationship, we have to keep scaling it up. If we don't, then, we kind of are out. So as a result of that strategy, it will always happen that the top 10 or top 15 client of ours will form a significant part of our overall revenue portfolio. It could be anywhere from 85 to 90%. Having said that, the strategy of the company is on twofold. One is keep increasing the client base and diversifying the revenue. And also, more focus is laid on the fact keep increasing the key strategic clients that we have, which can potentially become, multi-million, multi-year contracts and give us annuity business of 20 million plus. Mm-hmm. So as that happens, we will grow our client base and expand and diversify the concentration that we have today. But having said that, it will still be, our top 10 or top 15 clients would give us a significant part of our business, anywhere from 85% plus.
Earlier this year, you bagged an order from the Uttarakhand Power Corporation. What percentage of your earnings or your order book is from Indian companies, is in rupees?
So as far as on an annualized basis is concerned, the total value of that program is about 125 crores, which has to be executed over 18 months. A little over 50% of that we expect to book in this year based on the implementation plan that we have submitted. As an overall part of the revenue portfolio, I would say by the end of the year we would have about a little less than 10% coming from the domestic segment, domestic market, which in Uttarakhand government is one of the clients in that segment, and a major client.
So top client contributes 39%. Can you tell us which client is this?
It's a very large telecom service provider out of the U.S. So that's been our top client for the for the last so many years. As a percentage, it continues to come down. It was about 42% last year. Now it has come down less than 40%. In absolute term, it continues to grow, but as a percentage, it is coming down, and I would imagine that it will continue to come down as we move forward because some of the other larger clients are growing and taking away the share of the portfolio of our revenue. So to answer your question, it's a very large telecom operator out of the U.S.
All right, got it. Mr. Zutshi, thank you very much for joining us with all those details.